All right, so we've got a lot to cover today, so let's get started. Now, I should always mention, if you do like what you see on today's webinar, you want to try any of the concepts, if you've ever been curious, again, there is a risk-free trial with Life Design Analysis. Simply go to our website, click the sign up free. We collect very basic information, no credit card on sign up. We give you access to our top package, our premier package that I'm going to show you today. After the 30 days, you get the option if you'd like to upgrade to a paid subscription. If not, again, as I say, the account expires or goes to a light free account where you can get carrier-sponsored presentations in. So definitely sign up, try out the software. I'm going to log into my account, and again, it's important to note that Life Design Analysis is web-based. So you can access our services from your phone, from your tablet, from a PC or a Mac that I'm on today. Again, we're a web-based service, so you can access us on any different device. Our first topic today is really around kind of spring and the mortgage market heating up. So around this time of year, I've certainly noticed the signs in my neighborhood, for sale, coming soon, starting to pop up, really even as early as kind of mid-February. And again, with people purchasing new homes or transitioning and upgrading homes, there's a huge opportunity for insurance and sort of the changing need of insurance as well. So I think one of the biggest triggers, along with having a baby, is the purchase of a new house. And even clients who you've sold to in the past. Again, remember, our lives are dynamic, and there oftentimes are lots of changes. So we'll talk about, even as we go on through the webinar, just ways that we can reach these clients and prospects to them and engage them a little bit better, show them insurance for their specific needs, and we'll give you some strategies on how you can present to these clients and maybe some ways we can market and draw these kind of prospects out. Now, speaking of the triggers and marketing to these people, there's a great Deloitte Insight article that talks about the important life events that prompt our customers and our prospects to actually consider purchasing life insurance, and a lot of this article speaks to sort of the gap in marketing that sort of that premise that insurance is sold, not bought. It takes these as the most important triggers to have people actually go out and look for this product. So again, becoming a homeowner triggers that responsibility. You can see it's pretty much tied, very, very close. Kind of having children, of course, the biggest trigger. Again, the triggers to changes of overall financial situation. So it could be wealth or, depletion of wealth, becoming a homeowner, interacting with a life insurance agent. So again, just by speaking with our prospects and having a conversation, that's one of the most important triggers to help people realize all the different kind of needs. And then, of course, marriage. And again, you can see these are very, very close. Worthwhile read for anyone out there. It sort of talks about active buyers and what they're really craving, and again, engaging in a more digital consumer. So product awareness before purchase, post-purchase interactions with carriers, relationships and interaction with agents, and the digital channel and their role in the purchasing decision. But overall, the report really says two things: is that consumers' expectations have been shaped by the experiences they've received from other leading digital companies. So you think about your Apples, your Amazons. These types of experiences are characterized by clearly defined customer value proposition and reinforced with simple, easy, and elegant experience. And the research shows that typical consumers are losing their understanding of the value proposition of life insurance that it provides, and two, have not embraced the customer experience that leading modern online retailers provide. And that's what we aim to hope to help you with Life Design Analysis. We want to, again, always save you time. We want to create value through better communication, and we do that through digital visuals. And we want to make you more compliant. We want to document how you reached a decision, how you educated your consumer on those different options, so that later down the line, when if you do have to defend your work, you have a backup of it. So, let's get started and let's create a case for this person who has been triggered by the sale of a house. So I'm going to start off and I'm going to create a new case. And anytime you want to create a case in Life Design Analysis, you can say create a case. Of course, all cases have to be created for a specific person. So it wants, as step one, for you to create your client. Now, last month we did some basic webinars on creating clients and the very basics. So I'm going to assume everyone knows. But again, if you're watching this for the very first time, you can create a new client. I'm going to go with my client here, and I'm going to pick Mr. 40 and say continue. Now, Mr. 40 again is a client that I created, and you can actually see I probably created Mr. 40 over a year and a half ago, because Mr. 40, as I entered at the time with the birth date, April 1st, 1977, is actually 41, age nearest 42. So you can see as you do enter clients into the system or import your block of business into the system, your clients are gonna age, and again, we're gonna keep track of that and make sure it's easy to profile where they are with their current policies. And make sure you get the most accurate information. Now, I want to focus in on this concept of selling on time. So we're going to pretend, and again, I would highly recommend if you do have a prospect that you're starting out from scratch, definitely do the needs analysis. It's been shown that producers who do a needs analysis, not only do they get their clients the best coverage, but they also tend to end up selling more because they uncover a lot more of those risks. And again, having that conversation with your clients is certainly good. So I'm just going to quickly add a needs analysis for compliance here as well. So I'm just going to say they have no current insurance. We'll say they have no assets right now. They just spent it on this $500,000 house. But, again, we might want to add some income protection in there. We'll just say they don't have any young kids. Maybe, we know they're going to run up a little bit of household debt, or they've got a line of credit for maybe some additional enhancements to the house. And again, we could build in some last expenses. We'll say our clients are a little younger, so we'll put in $20,000 or something like that. Maybe they're more modern. They say they don't need anything fancy. Now, you can also add any other sort of label in there. Whether this is any other kind of liability they might have. So I mean, even things like childcare expenses or something like that you may want to add in there. I'm already at my 840 insurance need, so I'll just save this changes because we're going to be focusing on 500, but nice to have it on file that we've documented. I think you might need 840, but if the budget dictates 500, let's work more on covering the liability of the mortgage. So however your personal style is, again, highly recommend the needs analysis for compliance, but you can elect to leave it out there as well. Now, the first product that I'm going to start with is, of course, the obvious, the Term 10. So, with the plan that I'm going to set up, I'm going to do a comparison over time, because I know that my Mr. 40 client here, who's just purchased a house, doesn't need insurance for 10 years. I know he needs at least insurance for 25 to 30 years, depending on the length of the mortgage. And in our scenario, we can look at a T25 or a T30, depending on your preference. Just know, you can use the recipes. So if you wanted to get really, you knew which company, or you were focusing on a specific company, you can just do kind of a recipe and add all three products at the same time. So whether it was a T10 2025, T10 2030, you can use these recipes. If you wanted to get a little bit more granular on the product selection, you could use our plus term buttons to add products individually. Now, when you hit plus term, as many of you know, it takes you to the plan specification. So all your parameters around what term length you'd like to search. And don't feel you just have to do, a T10 2030 or like a T10 2025 or something like that. You can get creative with your term 15s and things like that. So there are even things like your opted term. So even if you're maybe reviewing someone who's maybe upgraded their house but only has 13 years left on the mortgage, again, get creative with those time lengths, because something catered specifically to the need is always going to be priced most effectively. So whatever your favorite product set is, you can certainly do that. I'm just going to start with T10 and hit search. Now, again, you can see I can go through my survey and I can see the ranking for top results. This functionality is integrated inside Life Design Analysis due to our partnership with LifeGuide. You've probably heard me talk about this. We give an exclusive discount for LifeGuide subscribers. It's a way for you to turn that information that you normally quote into something that has a more dynamic feel and a great way to market digitally to these consumers and give them that sort of experience that they're looking for. So again, remember, you can go through the sort of the list and very granularly select from these different plans. You can see, we might pick ones like Empire's because it's quite unique in its renewal schedule, and simply select them and say add to the case. So really, whatever your preferred companies are, you can sort that out and add the particular products that you want. Now, I want to focus on this concept of selling around time. So again, I already sort of mentioned, our client has the need for 25 to 30 years, and so I want to search over time rather than just show this, term 10. And certainly $410 $1,000 annually. Not a big deal for our $500,000 of insurance. So, we want to really focus on getting the product that's going to fit their time needs rather than, just their price needs. So, of course, clients like paying the least amount of money for their insurance as possible, and that's just human nature. I'm going to go ahead and I'm going to add maybe a term 15 into this. So I'm going to, again, go down and change my length, and I'm going to hit search, and I'm going to see all of the term 15s on the market. So you can see, again, I've got our different products there. This time, I'm going to add SSQ, nice term 15 into there, and I also want to add a term 30. So again, I'm just kind of repeating these processes here, and this time under the term length, I'm going to say 30, and I'll do a search again. Again, go through the rankings, pick your favorite companies out of there, and just simply add them to the case. And again, maybe I'll do an Equitable Life here and add that to the case. So again, whatever sort of product sets that you want. Now, you'll notice if I go down here that the analyze age has already been set to 30 years. You can play with this as well. I quite like doing it in the charts themselves, that dynamic experience. And you can also go down and create any kind of internal notes for yourself or report notes. Now, report notes for something like this, you might want to leverage even the types of life insurance, so types of insurance, which just goes over sort of the basic product types. And again, for a younger buyer who this might be the first trigger for them to purchase insurance, give them an overall education on this. But remember, you can also go into the concepts and make your own templates. So you can see, like if I wanted to make a new report template, I could call it, like Beware of the Bank. And again, I'll just give it a report title. That would also be Beware of Bank. So something like that. Ooh, insurance. And then again, in the report note, I could do something like, I could pull up an article here. So I'm going to grab a little bit of a link, and I'll come back and I'll say, here's my source. Maybe I want to throw that at the bottom. And I could, maybe just take a clipping from the article and say, here are some things that you might want to look out for. This one's going to be a little long for a report note, but that's okay. And I'm going to add that in there. So I'm going to take out these things. So again, you can of course format these a little bit and maybe condense them. But I'm going to take out here just these read more. So again, if you have some information that you like to use in each kind of case, again, you can make your own templates and things like that. So again, I'll just put that in there. And again, I'm just going to hit save. So I've got a new report template. You can see if I go back to my last case, so again, that little handy kind of reverse clock button, I get back to that case that I was working on. You can see once I create a report note or a concept, again, I can go in there and I can say, and now in my user defined section, you can see I have a new Beware of the Bank one. And again, my note that I was going to use goes in there. So again, I won't take the time to format this whole template, but I think you get the idea that you can create your own report note. So if you find yourself using the same note, and again, if you're doing sort of a mortgage campaign with your clients, you might be using that same sort of messaging over and over. So good idea to make it your own custom concept by going into that Manage Templates area there. Now, at the bottom, again, I can also select my report components. Given that this is, a fairly basic term comparison, I'm going to keep some of these on there. Some of them won't show up simply because they don't have cash value, things like that. I'm going to take out, though, things like the equivalent IRR and the internal IRR. I normally love these. These are great metrics to have on, on a whole life case, but when we're talking about, maybe some total costs, they may not be as relevant. We may want to make this a little bit more simple to our client, a little bit more easy and friendly. So I'm just going to save my report, given that I've taken off, a couple of the different settings. So what I've done here is, again, just to kind of recap, is I started up a new case for our client. I did a needs analysis to sort of establish, one, the big liability of the mortgage, but maybe a few of the other liabilities we may want to think about, just to back up our recommendation. We still went with $500,000 of insurance, and we were very granular in the way that we sort of picked these different products. So we specifically picked, kind of a 10, 15, and 30, and sort of a doubling. Again, remember, these presentations are totally up to you. If you wanted to add in a term 20, you absolutely could. So it's not limited. We find that 3-4 products is a great sort of comparison. Once we start getting a little more than that, again, we may just want to consider how many we're putting in there so we don't overwhelm. So we'll generate a report and just take a look at what this looks like. For everyone who's joining for the first time, remember your logo is going to go in there, all of your branding. Remember, prepared for your client's name here, presented by you. You can see you can customize a mission statement, so I really recommend putting in things like the companies you're licensed with. Some of those things that you have to include for compliance in every single report can go in that mission statement just so that they're checked off. And you can see, any sort of report note or custom note that you wanted to add in there, you could add in there too. So I just put a beware of the bank insurance and a few of the risks associated with that from that article. Of course, if I was doing this, without the, the time crunch of the webinar, keeping it within an hour, I'd polish this a little bit more as my template. But remember, that's easy to select in any sort of report that you make. So think about some of those notes or articles that you really like to share with your clients on certain topics, and really think about making them report notes and ingraining them in that workflow. So I've got a little bit of a report note. You can see our needs analysis here, really heavily focusing on that mortgage, but we also have some of those longer term needs, some of that household debt or even last expenses, things like that we added in there. So remember, you can make the needs analysis very simple, or you can make it much more robust as well. But nice to have some sort of documentation that these were liabilities that we considered. We came to an amount that was higher than what we're selling. Equally important that we identified it, but due to cash flow restrictions, we still went with $500,000 to cover that client's liabilities. And you can see, of course, any plan that you add gets shown up in here. So again, I can see my premium schedules over the time period that we're looking at. And we're specifically focusing around that 30 years. We're going to say that's the time of the mortgage. But as I said, customize these reports specifically to your client's time frame. And as I said, one of the best questions that my stepfather really would like to ask with every single one of his clients was, when do you want your insurance to end? Because even before we go into sort of this product discussion and how these products operate over time, it's likely your client's going to say, well, the purpose is buying it for the mortgage, so I want it to end when the mortgage ends, and for me, that's 30 years. And that's that whole concept of let them tell you when they want the insurance to end. We're going to base the whole premise of our recommendation around this aspect of time. Because as you can see, and a lot of clients, and they just don't understand, sort of this premise, even if we say, it's a term 10 and it has a guaranteed renewal, the gravity of how big that renewal is, and maybe the assumption that we're going to be healthy at these time frames where it's going to be critical to get more coverage, we're going to really see that out there. So again, great comparison over time that I think really puts into perspective, yes, there's an increasing cost here for the T30, but when we look at it over time, again, that's where we're going to see that break-even point. And again, if you're telling me your time frame is 30 years, let me know the plan that's best for you. T30, or is it these higher, more expensive lines? And again, as I said, you can always customize that time frame within the software. So if they simply say that term 30 is too expensive, you could look back and say, okay, let's get rid of it. You could also go down, and I'll just show here, really quickly, you can see in between all the different years in terms of the sum of premiums. And again, there's going to be a really nice contact page. But if, let's say we rule out that T30 just out of sheer cost, again, you can always go to the top of the report here and adjust that time frame. So you might say, well, look, let's focus on the next 20 years, and let's save that as our updated time frame. So you can always control that sort of the variable of time. You can even show what happens after the 30 years if you'd like as well. And again, I recommend leveraging that concept of time and when do you want your insurance to end, because if they say 20 years, 20 years is good enough, well, we may have a different lens on it. And again, at that time, we'd probably want to add in a T20 to look at that as well, because even our T15 is going to have the renewal point, showing that our sum of premiums is very comparable. Now, another way we can leverage this is maybe looking at something like a layered plan, where we want to do a couple different layers. And, again, I can leave this case exactly as it is, and why don't I spin up a new case, and I'll show you a really easy way to make layers for people in the mortgage market. So I'm going to work with Mr. 40 again, who probably should be renamed Mr. 42, because that's the age nearest. And I'm going to show you another way we can look at this, this sort of comparison. So, one really good way is, to look at someone with a mortgage as well is thinking about the different layers and how that sort of need changes over time. So another idea we might want to present to our clients, especially if maybe they like the idea of that term 30, but when they and they think about the overall cost, maybe it's just a little too much for their budget. And I can appreciate that. I mean, again, people with a new house, cash flow is always an issue. One of the great things I think as well for a mortgage market, because of the way mortgages are structured at the bank, and one of the benefits of insurance, especially dealing with an independent advisor, is I think the ability for them to get very creative with layers. And what I mean by that is, as we, really every single year of our mortgage, we're paying it down. In those early years, I know it doesn't feel like that much, but over time, really that liability that, we pegged at 500 is, it's really going to decrease as we pay off the mortgage. So if our client likes the idea of the term 30 over time, but the pricing's not right, at least we've got the concept of selling on time, and they've kind of identified the value proposition of why a term 30 works over 30 years. But again, perhaps for cash flow reasons, or simply just because they recognize that the liability is decreasing, we want to use a layered plan. Well, great option for them is to do a plus layer. And again, I can set my total insurance benefit. I might pick $1 million just because it's a little easier to splice it up into 3. But again, whatever the insurance benefit is, of course, you can always figure out exactly what each layer should be, and feel free to get creative, as I say, with how much you feel each layer should be. I'm going to start by adding my first layer. Remember, you can do up to 4 different layers, same sort of functionality as an individual search, except for it's going to repeat over each one. And again, I could do something like, I saw SSQ was in there, so I'm going to pick SSQ, and again, I'm going to say my first layer is $333,333. And the reason I do that is, as I add 3 different layers like I'm going to do, it's going to add up to very, very close to $1 million. You could put 99 cents if you wanted to get very, very close. I'm going to select my product group, so you can see, your layers don't necessarily have to be term only. My example is going to be, because I'm trying to keep costs low. But remember, a client with some permanent need could also leverage this strategy and have a term sort of rider added on there. I'm going to say term, and I'm going to say 10. And that's perfect for my first layer. I'm going to add my second layer, and you can see layer 2 here. I'm just kind of scrolling down. I'm going to use the same company for each different layer because I think it's going to be much easier if in a real situation to underwrite. But if you feel like you want to do different apps at different companies, go ahead. The one thing I would do is just kind of document in that final product which companies you went with, if you are kind of changing the name or anything like that. And again, I'm going to say term 20 is my second layer here, and I'm going to add a third layer, and again, same sort of thing, do SSQ. I'm going to say this is 333, so total we're going to reach close to $1 million, and I'm going to say term 30. Again, I could add a fourth layer. I'm going to say 3 is good, and I'm going to add decay. So whenever you're finished with your layers, and remember, you can do this even as just 2 layers. If you wanted to do, some T10, some T20, you certainly could do that. The other important thing to note about layers is that when you're doing layers, we automatically assume that you want to drop these at that renewable age. So basically when you hit the next period for that time, we think that you are going to want to drop that off and not pay the guaranteed renewal on there. And again, this is kind of a long name. We take all of the names and add them in there, and that's why I say if you decide that maybe you want to change the name just to make it a little bit more palatable for your customer, you can edit the name, and you might just say something like, I might take that out and I just did a cut, and I'm going to paste it down here. And I could even say even 1/3, something like that. And then I could just call this like SSQ layer, SSQ life layer, something like that. Again, I can save that, so it will reflect my new name. And then we can go ahead and generate the report and just take a look at what this sort of looks like. All right, so we get our report again. Remember, your logo goes here. You can customize all that up in the account settings. And again, you can go through your report. This time we're focusing on almost $1 million. We're about $1 short here, but we've got our different layers here. So you can see you've got 1 to 10, 1836. That's going to be our most expensive time because we've got full protection for the entire coverage. You can see though, years 11 to 20, after 10 years, we have that term 10 fall off. And again, like I said, with the layers, we've designed that to lapse. 11 to 20, again, our cost is further going to reduce because by the very end of this, years 21 to 30, we're just going to be left with that one layer of T10 of $333,333. So we're respecting the need for our client's time frame, but we're appreciating that, as their mortgage goes on, that their balance will decrease or that principal outstanding, and as a result, we've designed their life insurance to reduce as we go. So again, we're going to see a nice sum of premiums there. And again, you can see this is sort of the total accumulation here, but I think this is a very good visual in terms of how your coverage works. So again, $1 million up until the 10th year. At the 10th year, we drop and lapse that T10 because we don't want to pay the renewal premiums, and presumably by that time, we've paid off some of the mortgage. So you can customize these around. Another thing that's kind of neat is the annotation. So you can see when I actually move my mouse, you can see from on that exact data point on the chart that I can actually click on it and add an annotation. And this might be, term 20. So maybe some kind of note that just sort of describes it. So again, use your own sort of terminology and your own language. But again, those sort of custom, term 20 lapse, and again, you might want to add one at term 10 or, final coverage here, mortgage paid off, like that kind of thing. And again, remember, you can toggle these on and off. So again, when you're thinking about dynamically presenting, or if your clients are doing one, sometimes the annotations just, simply don't work out in the design space that you're looking for. You may want to just add a call out to another one. If you're ever looking to delete these though too, again, click anywhere back on that data point, select the text and delete it, and you can save it. And again, you'll see, that call out has disappeared, though of course you could toggle them on and off. And again, that comparison out, they can see sort of the wind down of that and how it corresponds to, their particular situation. So that's another great way that you can, sort of design a layered product to kind of fit those needs. And really the last way I wanted to show is that person whose cash flow is even, even less, and maybe a longer term length isn't even an option. I hear about this a lot of times from advisors. They say, it'd be great to sell them, a longer term product, but I don't think they have the affordability or the cash flow. Well, one other way you could use LDA in that sort of situation would be, still showing the value of an advisor and showing, why dealing with an advisor who uses LDA is perhaps better than an advisor elsewhere, and just being able to illustrate this sort of scenario. So the other thing I wanted to show you that's quite effective, especially for people with mortgages of 25 years, is the exchange provision inside of a lot of term 10s that are out there. So another thing that is highly effective and that can earn you business even when price is really an issue is the ability to, again, as I say, not only survey the market through that incredible life guide integration, but the ability that we add to that in being able to illustrate an exchange. So I'll just show you, if I search for, let's just say term 10s here, again, that same sort of list that we went through before, when we do select a particular product, we can always add it to the case as a reissue. So for example, we know our client has a longer term, but they can only afford, term 10 at the moment. And that's fine, but we want to secure their business and show why you should deal with us as an advisor. Well, one of the things we can illustrate is the exchange option. So you can see generally when I've been adding case or products to the cases, I've simply been saying add to case just by clicking the big green button, and that adds all the guarantees. And I think guarantees are important. Whether or not we think our client's actually going to hit the renewal is another story, but I think guarantees are important to illustrate. Now we know the reality is, and again, it does assume risk. Everyone who's listening to the webinar probably understands that, there is a high likelihood that someone who's 40 will be able to purchase insurance again at age 50. Of course, it's going to be more expensive due to their age, but we may say, hey, this is a healthy person, and if cash flow is sort of that limiting factor, we may want to, again, secure the business by illustrating something like a reissue or an exchange, which I wanted to show. So, particularly, as I say, for someone with like a 25-year mortgage, this is a great strategy, as they could purchase the term 10 and then after 5 years exchange it to a T20 at their increased age. And again, I'm going to select that option. So the way that I get to that, again, is not hitting add case over here. It's by this little drop down chevron arrow that I click, and then I say add to case as a reissue. Now you can see most companies offer about a 5 year, so you have to do it before the 5th year of that term 10. Generally, you must also be younger than 65 to take advantage of this, which makes sense. Canada Life, I believe, has a 7-year exchange, but I'm still going to do the 5th year for them. So I'm just going to select that option. And again, what our software does is it goes out and grabs that initial term 10 price, chops it at 5 years, forward dates the age of the client, and searches for the term 20 within that same company and adds it to the case. The other thing that it does, and I'll show you in there, is that it automatically adds a disclaimer that talks about that it is the assumed current pricing. So the only thing we don't know in this scenario, we know you will have that exchange provision, but we don't know necessarily what a T20 will cost in 5 years. So that's the only assumption we're making in there, but it's quite a good way to model it out. And again, if cost is really a factor, it's still a great way you can use LDA to highlight your value proposition, that you know about these exchanges, and that you can execute a strategy that makes dealing with you, a value add. So again, I know this strategy, and it ultimately will save you money. So I've just added it in there against the SSQ layer, but you can see here, got the 5th year, we go up to the T20. And again, for this, at the end of the 25th year, that's when we're going to see that T20 renew. So we have that giant spike. When we're looking at accumulation, though, again, we might say, we'll deal with it at 66, or if we only had a 25-year mortgage, that might be the plan. And this is another great, again, we're seeing, the difference. We can't really see it because we've got this giant T20 renewal throwing off the scale. This is another great opportunity. You may want to go to the top and, again, play around with that time. So in this case, if we said, analyze the years, let's focus on a 25-year mortgage and look at the end of that exchange and say, if it wasn't a T30, let's just say, it was a different situation, what would we be better off with there? So remember, you can use that time control to change, the look and feel of how the graphs scale. So again, this is kind of a neat one. We see the layered plan actually reducing in cost. We see the other one starting off lower, but then because we exchange it at our increased age, we pay more long term. Then again, this one has full coverage for that 25 years, where this one is decreasing coverage. So, lots of things to compare, but it gives our clients some options. At the end of the day, the layered approach is actually more affordable, and then I think that makes sense because, again, we are decreasing the insurance benefit down to $333. And again, you can see it's about a $10,000 difference, but the insurance benefit is quite substantially different. So again, in the 15th year, you can see we have $333,000 of difference. So you can see, the SSQ layered approach went from 9 down to 6. The other scenario stayed at 9 the whole time. It ended up costing a little bit more, so $50,000 over the 25 years versus 38. But, again, we got a lot of extra coverage by the end of the day over the whole course. So really two different strategies, and I would say, use them based on the scenario. But those are a couple different ways you can use time and different layered strategies to engage people who are purchasing a house. And as I say, we know that's a big trigger for life insurance, so leverage that to your advantage and make sure you're making comparisons, regardless of if they're just looking for a term 10, you want to show them the exchange, or if they're looking for layered solutions or longer term products. Now, the last example I wanted to show around this, and I can actually add it to this plan as well, is another function that we basically write on top of, and that's a term rewrite. So again, very similar to the exchange where we're taking a T10 and exchanging it to a T20 at the 5th year. The rewrite assumes that we have a client who maybe wants to take on a little bit more risk, and again, this is something that we could still illustrate to a client as perhaps a riskier option. But all the same, if they feel they're going to be healthy and are willing to take the risk, we can still illustrate it. So a great example of this, and again, I'll create a new case just to keep things simple. Remember, you can make as many different cases as you'd like, vet lots of different scenarios out there. Again, I'm going to keep working with Mr. 40 here and say continue. Now, one of my favorite places for the sort of the rewrite, and again, this is a client, and it's fine, if you have someone who wants to take maybe a little bit more risk. Again, any sort of face value works. I'll pick $1 million, and again, I'm just going to say term product. And I'm actually going to start with a 20-year term product, and maybe this is our follow-up. We did a couple different scenarios on let's say we first condition and sell over time, and we show that T10, 20, 30, and just the advantage of locking into a longer term product or a product that fits our particular time needs. And again, once we've established that, we have a good foundation of saying why we recommend a certain product. Sometimes we're going to have clients who, they might say, well, look, what happens if I buy the term 10? And as you said, one, I can exchange it, which is a great scenario. But what if I keep reapplying? Like, what does that look like if I keep purchasing insurance every 10 years? And again, I think a lot of healthy clients or clients who, think they're particularly healthy, might appeal to this. Well, I'm in great shape. I'm 30 or 40. I'm going to be able to buy insurance when I'm 50. And, I may not even need that insurance when I'm 60, or I'll need very little of it. What are my options? So we might want to vet that scenario and actually show them what the risk is. And again, maybe it's, something against our T30 or something like that, or our T20. So again, remember, I can go and select anything. I might actually, let's do the T10 here, because we do have a client who's 42, and let's actually vet it out against a T30. So I'm going to do the search, and I'm going to start with kind of our baseline number. So let's say we've appealed to our client, and they see that the value of that T30, and they say, okay, I really like that. But why wouldn't I keep purchasing insurance over time? And we want to use another way to either show them that here's how we would model that out, or here's why that might not be the best scenario, or might not actually save you that much money. Because I think a lot of people don't realize that their age is a huge factor, regardless of if they're healthy or not, or actually get an offer at an increased age. This is actuarial science. There is these rates and tables were set out to design to make a profit, and they're designed to reward customers for long-term commitment. But what I want to show is I want to make this point, and this will be an interesting one. So I've added in my T30, but what I'm actually going to do is I'm going to say I want to add a term product, and I'm going to search for a T10. So we're going to model that scenario where the client takes all of that risk of saying, I'm going to be healthy and I'm going to keep buying. And again, go through, you can see, all the different companies out there offer this sort of thing. Manulife has that YRT renewal on there, things like that. But essentially, same sort of thing. Instead of adding the guaranteed renewals, I'm going to use this little chevron. And we talked about it a little bit in that last case where we were going to say adding it as a reissue. And you can see, just like the exchange option here where we have 5 and 7 years, we have two options for the reissue. So I'll just talk about them briefly. Number one is my favorite, and that says add it as a reissue. What it does is, in our case, if our client's 42, it's going to look at adding the first 10 years, and then it's going to say, instead of adding the guaranteed renewal at age 52, let's go up and search again for a brand new rate, making the assumption that they've applied with full med. So it's a brand new product. They've lapsed the other one. They reapply, and this is a new product at the end of that term length. And it's important to also note this works with term 10. It also works with T20. It works with the length of any different term product. But let's focus on the reissue. So at some point, our client who's in our case is 42 gets 52 repurchases, 62 repurchases, 72 repurchases. At some point, there's going to be a knockback where they'll say this client is simply too old to purchase insurance. They would either have to go with the guaranteed renewal from their previous age. So in our case, it would be something like their 72 would take them to 82, or in Manulife's case, I believe it's only renewable till 80. So at 72, it would say, nope, sorry, we can't purchase insurance anymore. You'll have to go with the guaranteed renewal. We could also say stop on that guaranteed renewal. So whenever you hit that max age where I can't purchase it anymore, just lapse the product. So we give you the option. I like adding it as a reissue because I say, you will have that option. And I like seeing the big renewal premium at the end of the day because, depending on what age the client actually is, when they hit that max point, that's what's going to determine, a lot of, if you lapse it and you're 72, well, that's a big difference than if you lapse it when you're 79, and, depending on the need for insurance. But just so you know, it's a great scenario that's out there. Again, we're doing this a reissue. And again, I've just capped this at 30 years. So when that T30 is done, we just want to model it out and say, okay, you thought the T30 was expensive, but you wanted me to prove to you that it was still better than purchasing a T10 every single year, assuming you're healthy. Again, it'll be a good experiment. Let's take a look at it. So again, what we see here is, on that Manulife Vitality, we see the reissue and we see the disclaimer that's added. This one assumes two things. It assumes, one, they're going to be healthy enough to purchase it in the 10 years or whatever increment the term length was. And two, again, it assumes that we know what pricing is going to be like in 10 years, 20 years, and 30 years. Again, it's a big if. It's more of a conceptual modeling out that proves that, again, what the big determining factor is one is our health, and we're making the assumption that's good, but two is really that, there's no free lunch. Our age is going to be a big factor in determining how much our insurance costs. So you can see, it's no question that the price increases. Overall, though, what we want to determine is it worthwhile saving the money in the early years, even if we do end up paying more. So again, is all this time underneath the curve here going to offset that this is much more drastic over the curve? And again, you can see when they actually come out at the end of the day, even over 30 years, the term 30 was actually a little bit less expensive. And we're not talking a big margin here. It was $80,791 versus $81,477. And again, there's a lot of risk, especially over 30 years, particularly at age 61. You're taking a lot of risk that you're going to get an offer there. And again, that it's going to be a standard one. So this also assumes that it was a standard offer. You could build in some kind of rating when you do this. The other thing I might recommend when you're looking at this sort of strategy, and just to be on the side of fairness, is sort of the concept of time value of money. So, you may want to set some kind of discount value or present value to it. And the whole argument is that, sure, the price is due to increase in 10 years, but due to things like inflation, that may not be the case. And again, adding a PV like, 1.5 for inflation or something like that, or 2, that over 10 years, 30 years, some of that inflation pricing is going to get factored into the cost of insurance going forward, which, again, we don't know. None of us know, really. Technological advancements in the industry could drastically change the price of insurance over the next 10 to 15 years, but it's a good representation. So something you may want to consider is adding some sort of PV that shows that, over time, sure, the premium, is this, so what started out an annual premium here of $2,000 today seems like a lot. In 30 years' time, that's more like an annual premium of $1,486 in terms of today's dollars. So that's sort of the discount value that we see with inflation. Present value is excellent for kind of vetting out those different scenarios. And some might say, we would have taken that money and invested it. You can vet that scenario too. And again, a lot of that depends on client behavior as well. But what we see is we're taking a lot of added risk, and even with a PV of 2%. We're not really seeing that much of a difference in terms of premium here. And again, the inflation factor now, it's $6,000 versus the $1,000 cheaper. So again, if we go back and take off that PV and just say, okay, we're not going to think about time value of money, and we're going to assume that some of that inflation pricing actually gets factored into repurchasing after 10 years. Again, we're going to see very close. In fact, the T30 is slightly less, as I said, $686.40 less, taking no risk. As soon as this premium was paid, all the way through, guaranteed insurance for that 30 years. This one included some risk. As you can see, it was a little bit more expensive. When we start factoring in things like time value of money, we could make an argument that a little bit less expensive that way, especially if we think about buy term invested difference. But again, really, that's a big behavior thing, and I think it's taking a lot of added risk for not necessarily much reward. But again, it's there for you to compare depending on your personal strategy. All right, so the last case I wanted to show was around maybe making a more of an advanced concept, and this is something that you would share, maybe on an email campaign, or it could even be a social media campaign, and it's really all going to be designed around creating and marketing that interest in, people whose this is the topic that's on their mind. So again, we saw the sort of the stats around the trigger. when people purchase houses, they go out looking for this information. Remember, we want to be where our prospects are. A lot of the time that's going to be on social media. Again, sometimes it's going to be your email marketing list. That's going to catch people who have had life events. Maybe you've sold to them 7 years ago. You have no idea that the mortgage is on their mind, but you send out a marketing campaign that has to deal with this concept, that has some engaging content with it. We're going to show you how you can use that with a shared link to actually capture who's looking at it, how long they're spending on it, and really get some engagement stats around people interested in this concept. Now, I've actually created a case before on Mr. Mortgage, and again, I'm going to share a blog that we do that has how to set this up, because I am running out of time here. But again, I'm going to go into my cases here, into my managed cases, and I'm going to look for a client that I call Mr. Mortgage. You can see I've cloned this case to to work with different scenarios here. But let me just view this one. And basically what I've done is I've set up a term 25 here, and I've got a 35-year-old client here. And what I've done is I've set up mortgage insurance from the bank. And you can see when I expand this, basically how I added this was a plus manual. I'll show this really quickly. I started with a $500,000 house, and then basically I made an assumption for how the the mortgage on this property was going to be paid down over the course of that 25 years that we're going to have it. So we're going to say in the 25th year we're done the mortgage, and we're not paying insurance on it. Now, what I did to actually get the premium for this in here was, I'll just show you really quickly. I used a plus manual. So anytime we don't have through that Life Guide integration, we don't have mortgage insurance rates from the bank. They're not too hard to find. Usually you can find a cost per thousand table. So let me just see. Or maybe there's even a calculator. Generally, they're published on the actual company sites. When I did this, I basically pulled their cost per thousand table. So generally, they have a cost per thousand based on the age bracket that a single person would be. So essentially, I just created a quick Excel sheet that corresponded with my down payment and entered it in here. So, based on the cost per thousand at $500,000, I determined it was $780 per year. But as my age increases and I work my way into those different marketing bands, my cost per thousand goes up, and correspondingly, my total insurance benefit actually goes down. So those are some of the the negatives about it. You can see again, you can add in that beware of insurance from the bank's note to add some custom ability to it, and then compare it to a product that you think fits. So again, in contrast to the mortgage insurance, I've set up a T25. Now I'm just going to generate this and I'll show you what the report looks like. I've culled a little bit of the report metrics, and as I say, I've got a blog post on this that I'm going to share on the topic if you're interested in setting one of these cases up. As I say, I'd make these more as placeholder ones. It's really not too hard to beat the bank insurance in terms of cost. When you're looking at the insurance benefit, I think this is a really effective chart though, showing how that, when the principal decreases, the amount of insurance that you actually have decreases. And when you look at the cost, again, we're going to cap this at 24. So again, let's go play with that time a little bit and move the time back to, 25 years. So we'll save that. Just so we can condense, of course, after the 25 years that, the term 25 absolutely takes off with that guaranteed renewal, but we're going to pretend that we don't need insurance after this. And this is a great, again, representation of, the bank insurance is gone. If you want to choose to have insurance after, past 25 years, again, you absolutely can with insurance coverage that you own. And as I said, that cost per thousand made it really, really expensive right off the get-go. It's likely, we know everyone in our industry, I think, knows, this is quite a profitable product for the banks and not good for consumers at all. We put some of those pros and cons. I think the only pro of mortgage insurance is that you can check a box and get it. The con is that you don't even know if it's going to pay out because of post underwriting and things like that. So consumers definitely need to be aware of some of that. So structure that in your presentation. The cost element is going to be compelling when we see that regular insurance from an insurance carrier is a lot less money, so it's going to save us money. We always like that. And not only is it going to save us money, we're also going to have more insurance benefit all the way across. So even though, in that 23rd year, if something were to happen, sure, our mortgage might only be $31,000. That's all the bank's going to pay, even after we've paid all those premiums over time. We'll have all of that coverage. We'll have 400, and you can see in my example, I've got a little bit of a PV in there. We'll have 499,000, but essentially still that 500,000. Again, very, very compelling visual is that cost per thousand, looking at it versus a traditional insurance product. This is an average over the 25 years, but you can see, amazing sort of scenario. So once you have your case set up, again, what you want to do is you want to go and share it. And I'll just go back to square one here, and I'll unshare this to show how you would do that. So once you say, okay, this is a very generic report that I could share with a wide audience, to kind of illustrate the concept of creditor life versus a true life insurance policy. What we want to do is we want to click share and grab this unique URL. And this is sort of going to be our call to action for our analysis. You can set an expiration date, so if you're worried about that term 25 pricing changing, you certainly can. You can also request information, and this is that sort of that gate that's going to be that marketing lead for us. So what we're going to do is we're going to say we want first name, last name, and maybe we want email, especially if we're posting it over social media where we don't know who's going to join, and they may be prospects brand new to us. An email marketing list, more internal to your organization. You may know the first and last name and be able to know who that contact is. You may not want them to have to re-enter the email. Totally up to you. If you anticipate having to quote for these people, like if you're using this gate and then want to turn around, what would the cost of a T25 or a T30 for them to be? You can also do things like require their date of birth. So if you're going to turn around a quote on that, you can. So these are basically your parameters of, what do you want to collect or make required before they can view this case. And again, just remember, if you do change these, just update the information after. The link will stay the same, so the link is tied to the case, but the information is when you update it. So I've required first name, last name, and email. Now, the next thing I'm going to do is I'm going to create a campaign, and again, as I say, these can be very different styles of campaigns. We have a couple of different templates in our help center, but I'll show you what I mean by structuring something for a prospect, and I'm going to use our CRM, which is Agile. Now, it's not really important even that you have a CRM necessarily. There's lots of even mail platforms like MailChimp, and again, I have no affiliation with Agile. There's lots of CRM companies out there that you may be familiar with. I would say look for one with marketing automation and sort of these templates because, again, these are going to be very handy in doing sort of campaign mailing. So you can see, this particular, our program has sort of content that you can customize. And it's very drag and drop. They make these very easily, so if you wanted to add text to a certain area, you would just drag it in. And this is not unique to, as I say, Agile. This is very similar. You'll see this in MailChimp and other mailing things. But essentially, you're creating a campaign to create awareness and draw out those people who are craving information about this. So, my point is, it doesn't matter necessarily what CRM that you're using. I can recommend if you're looking for, different programs or platforms or advice on this, certainly you can ask us. We have a lot of experience in this area, though that's not our business. The point is, though, what we want to do is we want to create awareness, as I say, about this sort of concept, and we're trying to get people who are actually interested in this. So again, as I say, we may not know, the intimate details that even one of our prospects or clients has sold their house, but because it's on their mind when we send out the newsletter, it's going to catch their attention. And all I've really done in this sort of concept is I took one of those, sort of pre-made templates, and I'm using the same sort of information that I used in my report note in LDA. So beware of insurance from the banks. And, I even used the taglines, banks sell mortgage insurance. So I took it right from the top of this article to build out this campaign. And again, I did this very quickly. You can take, add your own verbiages in and imagery and things like that. But I just put, some of the information about this concept. So again, you want to give a little bit of education about why you should beware of the bank. These are some of the cons. So we go over some of them. And then you can see we put in a button here. And this is sort of the call to action that, again, we want to nurture our clients in a couple ways. So one, we're creating awareness with a little bit of information about the concept. But inevitably, and as we saw from our Deloitte study, is that people want to get engaged and they want to review the pricing and actually see the differences for themselves. Like, what is that dollar value? You say it's bad or you say it costs more. What's the actual dollar value that we can associate with that? So you can see on our sort of what we would call a call to action or our button, you can see that this is a link button. And you can see I renamed this to mortgage insurance versus life insurance. But again, this is where we want to, instead of having the URL, we want to insert our case link. So again, when they click on this to see the pricing differences, again, what I'm going to do is I'm going to copy our URL. And this is just from that Mr. Mortgage case we designed over here. We're going to insert it in as our link in our CRM, and we're going to hit save and close. And again, as I say, this is very drag and drop, so if you're intimidated or think, oh, I couldn't possibly do this. Again, lots of templates out there that you can use for free, and again, it doesn't take a lot of skill to drag and drop these sort of things. We also put underneath that a what should you do instead, and consider life insurance. And again, customize all of this information so it's specifically to you. I've just spun this together really, really quickly. I'm just going to save and close, and I'm just going to save our template here. So I'll just call this and I can give it like Again, really important that I spell things right, especially if I am going to email them out. Bank. So I've got that, and I'll just say this is a branded template. And again, I'm going to save that. Now, the whole idea here is that when you have a marketing list or sort of an email list, when you send this out, again, we're going to get a nice detailed marketing campaign. On the computer, it's going to look like this. Even if they're looking on their smartphone, it's going to look like this. Give some information about the concept. And then when they get to this button that we call the call to action, they can actually click on it to go view an example case. Now, I've actually sent one of these to myself out of the campaign, and again, I encourage you to put your logo and things like that, but that's how easily we can create sort of a campaign around and raise awareness about mortgage protection from the banks versus life insurance. And for anyone who has that topic on their mind, they can go through and take a look. Now, as I say, consumers these days, they really want to know, you say that bank insurance costs more than traditional life insurance. They want to know what's that number, and that's where that call to action comes in. And you can see I'm just going to open this link in a new incognito window, otherwise it knows that I'm logged in, and you can see it takes me to that shared case link. Now remember, when you're the advisor, your logo goes on all of this, but you've set up that gate to collect things like first name, last name, email, and if you required, even something like date of birth. So when your client comes to view it, and maybe I just put that this is Bob Dobbs, and I put in my email, bob@dobbs.com, and I can proceed. And only those people who are truly interested and actually want to see, what's the case look like. And again, remember, this is fully branded with your logo, gives them the digital experience. They get to compare prices and get educated on their own time. All of those things the Deloitte study pointed out that consumers want. They see the obvious benefit in, the increased coverage that we talked about, especially for the reduced cost that it is. And again, all of your information. Now, the benefit, again, is that they can comment or call you directly from this. All of this is linked to the information in your account settings. But I think, again, truly, when again a prospect jumps out of it, and again we've triggered that interest. When you come back into LDA, and again, it's as live as soon as you refresh the page, you're going to get a notification on people who visit. And again, you're going to be able to see, exactly who it was who visited. So again, these prospects of yours who are interested, and depending on, sort of the information that you've required, you'll be able to pull out the prospects who have spent the most time versus maybe people who are kicking the tires. But that's a great way you can use a concept paired with a shared case to draw in even more inbound leads around this time. And especially as, sort of the mortgage market is heating up, people are buying and selling houses. Again, this is a great way to create a lot of awareness. Now, I set this up as a mailer campaign, but there's no reason you couldn't set up, an article that you share with a call to action for on social media, where again you don't necessarily want to pump too much product. You're more pumping a concept, but the call to action is for someone to compare the product, which leads them into the gate, and again gives you that contact information where now you can follow up and sell them. So that's a great way that you can use, sort of a shared case link with inside of a, sort of a more of a marketing capacity, but really, again, create that digital connection. Now that sort of brings me to the last topic. I know we're running out of time here, but again, some of the notifications in Life Design Analysis, again, are going to feed you things like shared case visits, but I wanted to bring everyone's attention to the notifications as we've made a few updates to them. So with all the different new notifications for things like groups and with the intent to purchase, as well as all the shared case notifications, we wanted, and we got some feedback that people wanted a better way to work with notifications and work through the different notifications, especially when, if you were part of the pilot we did prior in-force pilot, you would have gotten sometimes up to 50, 60 cases batched for you. Sorting out between, which items have been, read, unread, which ones have been actioned was a little bit difficult. And so we've added the ability to, one, filter between different opportunities. So for example, if I just want to see all of my notifications for Term 10 conversion opportunities, I can go through and see them. You can also see we added the ability to mark as read or unread and the ability to delete. Now, we also got a lot of feedback around sort of mass action. So that's great, but I got a lot of notifications and I want to delete them all, or I want to mark them all as read or unread, things like that. Well, now you can go into the mass action. If you click this update button, and again, I'm going to play with the layout here and the colors a little bit, so when you see this, it might look slightly different, but essentially what you're doing is applying a mass action. So, let's say I want to mark all of these as read. I'm going to select all of them, and I'm going to say apply the mass update. Same sort of thing, again, if you wanted to, see a certain, like a custom opportunity or something like that, or just birthdays. Again, you can filter down and mark certain ones as read or visible, or delete them altogether. And again, that works with all the mass actions. Now, the other thing I wanted to draw attention to that I don't know if enough people take advantage of is the ability to create a custom reminder. So remember, when you are, following up with some of these prospects, or let's say for example we do something where we say, okay, we're going to do a Term 10 and we're going to exchange it in 5 years, we do want to create reminders inside the system. So again, you can create certain reminders to go back to certain items. So if it was a particular client or something that you were working with, or a particular case, let's just say it's our sample case here. We can always take a URL here. We can go back to our notifications and we can say we want to remember this client on this particular date. So I may say a year from now, February 2020, on the 1st of February at noon, revisit. Something like that, and create your own reminders. So remember, you can create reminders inside the system. We have a lot of automated policy opportunity notifications, client case visits, birthdays, those kind of things. But don't think you have to be limited. You can also create your own reminders. So I know I'm a little bit over time, and that's kind of the second month in a row. I'm trying to squeeze a lot of content in. I hope everyone got value from our session today. If you have any questions following the webinar, please send them to info@lifedesignanalysis.com. Remember, you can always go to our website, sign up free, do the free trial if you haven't done so already. Hopefully, if you've had a trial and you're considering our program, hopefully you will check out our different pricing options. Remember, we do have different subscription packages depending on your features. You can always compare the different features and plans. And remember, those of you who are Life Guide subscribers get that exclusive discount on our software. Reach out to us, ask us a question on our live chat. We're more than happy to speak with you. But I think you'll experience what most of our subscribers do, and that's a real increase in saving time, an increase in profitability, and really some of those automated compliance features that are baked in there. So having a documented record of all of your cases, knowing you surveyed the market to find the best options for your client. These are all benefits that that we want you to experience. So thank you again for participating, and look forward to seeing you on a future webinar. Take care. Bye-bye.